Everyone is talking about the next big crash, and you are right to be concerned about where your money is going. The real danger is not a sudden collapse, but a slow erosion of your purchasing power while you wait for a market correction that never arrives. By the end of this video, you will understand why the current market environment is fundamentally different from the dot-com era and why valuations may stay elevated for years, not just months. To understand why this matters, we have to look back at the year 2000 and the dot-com bubble. That crash was a classic liquidity crisis. Investors poured billions into internet companies with no revenue, no profit, and often no viable business model. The entire Nasdaq index soared on pure speculation, but when the money ran out and interest rates rose, the liquidity dried up. Companies that could not generate cash flow simply vanished. Valuations collapsed because there was no structural floor to hold them up. It was a sector-specific event where capital fled a single industry once the excitement faded. Here is the thing that changes everything today. We are not dealing with a sector-specific liquidity crisis. We are living in a regime of fiscal dominance. This means the government and central banks are so deeply in debt that they are forced to keep asset prices high to service that debt. When a nation accumulates trillions in liabilities, the cost of a deflationary crash becomes higher than the cost of keeping inflation running. So, central banks are effectively compelled to keep interest rates low and liquidity flowing, even when it creates asset bubbles. This creates a structural floor under valuations that did not exist in 2000. This brings us to the second major difference. In the dot-com era, capital fled to tech stocks only because they were the new, exciting thing. Once the hype died, the money left. Today, capital is trapped. The global supply of safe, yield-bearing assets like government bonds has shrunk dramatically due to debt saturation. There simply is not enough high-quality debt for investors to buy. When you cannot find a safe place to put your money that offers a decent return, you are forced to look elsewhere. You are pushed into high-growth technology equities and other risk assets not because they are cheap, but because there is no alternative with comparable yield. This is not a temporary spike in demand. It is a structural necessity for the global financial system. Quick resource note: I keep a curated set of Amazon search links in the description for books, gear, and tools relevant to this channel's topics. Some are affiliate links, so I may earn a commission at no extra cost to you. Please consider supporting the channel by using those links if you find something useful. Now consider this perspective from an engineering standpoint. The dot-com bubble was built on infrastructure for non-existent demand. Companies built massive fiber optic networks and data centers before they knew who would use them. It was a classic case of building before the market existed. The current boom, driven by artificial intelligence, is different. The return on investment is immediate and measurable. Companies are already using AI to reduce inference costs, automate workflows, and generate revenue. The infrastructure is being built for actual, immediate demand, not speculative future promises. This means the bubble will not deflate through a sudden liquidity freeze. Instead, it will deflate slowly as companies optimize their architectures for unit economics and profitability. This leads to the most critical insight of all. The failure mode of this cycle is not a crash, but a zombie equilibrium. In the past, failing companies would go bankrupt and their assets would be liquidated, cleaning up the market. Today, because the cost of capital is artificially suppressed and government subsidies are available, underperforming companies can survive indefinitely. They can keep borrowing cheap money to cover their losses. This creates a market where valuations remain elevated not because the companies are growing fast, but because the cost of capital is so low that even inefficient businesses can survive. It is a market where the weak do not die, but they also do not thrive. They just exist, holding up the price of the entire sector. This dynamic explains why you might see valuations stay high even when economic indicators suggest a downturn. The market is not pricing in growth potential alone. It is pricing in the certainty that the system will not allow a hard reset. The government cannot afford a 2000-style crash because it would destroy the value of the sovereign debt it needs to manage. Therefore, the system is designed to keep prices elevated, forcing investors to accept lower real returns in exchange for staying invested. This is the new normal. You might be wondering if this means you should stop trying to time the market. The answer is yes and no. It means that waiting for a dot-com-style crash is a strategy that will likely fail. The conditions that caused the crash of 2000 are gone. The structural forces are now different. The bubble is not a temporary glitch in the system. It is a feature of the current economic regime. This does not mean prices will go up forever. It means they will stay high for a long time, fluctuating within a narrow band, supported by the very real need to inflate asset values to manage debt. The cognitive dissonance you feel comes from expecting a historical pattern to repeat when the underlying mechanics have changed. You are looking for a liquidity crisis in a system defined by fiscal dominance. The lesson here is to adjust your expectations. Stop waiting for a crash that the system is designed to prevent. Instead, focus on asset allocation that works within this new reality. Understand that the risk is not a sudden collapse, but the slow grind of inflation eating away at your returns while you wait for a correction that may never come. The most valuable insight is that the bubble is not a bubble in the traditional sense. It is a structural inflationary regime. It is sustained by the lack of alternatives and the necessity of fiscal stability. This means valuations will stay elevated not because they are cheap, but because there is no other place for the money to go. This is a fundamental shift in how the market operates, and ignoring it is the most expensive mistake an investor can make today. Thanks for watching all the way to the end. I am a one-person team working hard to make each video better than the last. Subscribe if you found value. It is the best way to show support. Drop a comment with your biggest takeaway. See you in the next video.